Welcome to GEPL Capital Talks on Tuesday, a weekly podcast, bringing to you an interesting talk related to finance every week. Stay tuned. Subscribe now and press the bell icon to GEPL Capital's YouTube channel and never miss out on any stock market update and build your knowledge on investment. Hello everyone. GEPL Capital brings to you Talks on Tuesday, a weekly podcast, episode number 44. Our today's topic is 5 differences between Multicap versus Flexicap funds by our financial planner, Hetika Ladhani. Over to you.
Hello everyone. On September 11th, the Securities and Exchange Board of India tweaked the rules for investment allocation by multi-cap equity funds, which led to a whole lot of frenzy in the mutual fund industry. Let's do a 2-point analysis to really understand what could be the impact on these new norms on the industry as well as on the investors. 1. What has changed really? Well, SEBI has said that a multi-cap fund must invest at least 25% each in large caps, mid caps and small cap stocks. Now why? A multi-cap fund is an open-ended equity scheme investing across large caps, mid caps and small cap stocks. Till now, multi-cap equity funds had to invest a minimum of 65% of their total assets in equity and equity-related instruments, and that's without any category limits. Now, under the new rules, these funds have been asked to invest a minimum of 25% each in companies that's across all sizes. The remaining 25% has now been left to the fund manager's discretion. 2. Has SEBI new norms made multi-cap funds more true to label? Well, yes. SEBI has done this as the portfolios of many multi-cap funds were tilted towards large cap stocks. As per Morningstar data, top multi-cap funds were found having exposure to large caps between 60 to 70%. Jan 2021 was the deadline for the funds to comply with the new norms. After the release of the circular, fund houses expressed dismay as it would limit their ability to move across market segments. However, the sudden offloading of large cap stocks would disrupt the market. Subsequently, the Association of Mutual Funds in India requested SEBI to come up with a new category which would help multi-cap funds transition without too much of portfolio disruption. Hence, the AMFI data on mutual fund flows for January saw a debut of a new equity fund, that is Flexicap funds. Now, what are Flexicap funds? The Flexicap fund is an open-ended equity scheme which will invest at least 65% of total assets in equity investments without any defined limits in terms of exposure to large cap, mid cap or small cap in the market. Flexicap fund and multi-cap funds will have portfolios that are constructed to different mandates, and investors should have different risk and return expectations from them. Now, if the fund is with new multi-cap regime, it would mean a change in risk and return assessment of the fund, since the portfolio will now have to align to the revised rules. Also, check if there are other changes in the investment management strategy. For investors with limited investable surplus, a flexicap or a multi-cap will work as a good first-time investment that gives them exposure to different segments of the stock market. They now have the option to choose between the flexible portfolio strategy of flexicap funds and the fixed allocation strategy of multi-cap funds. Use this opportunity to understand the investment strategy before making an investment decision. If it's a flexicap fund, understand how the fund interprets this flexibility. Now, if investors are not comfortable with the fund manager having the flexibility to decide on segment exposure and would like a more structured portfolio with greater visibility, then the multi-cap category is what they should consider. However, the rigidity of the exposure that the category has to take may make the fund riskier. If you are looking for a longer investment horizon, a change of category will mean that you have to realign to the risk and return parameters of the new category. If you are considering a switch to a multi-cap fund, you may require a longer investment horizon as compared to a flexi-cap fund, given the larger exposure to mid-cap and small-cap segments of the market. A large cap oriented flexi cap fund may be suitable for investors looking for a stable ride with mid and small caps, giving a boost to returns. On the other hand, flexi cap funds that look at actively managing segment allocations in line with expected performance may be suitable for those investors who are willing to take greater risk and better returns. Mutual fund industries should have different risk and return expectations from the two categories of equity funds. Consider a change in category if the needs of your goals from your investments have changed. Thank you.
Thank you, Ms. Hitika, for this interesting insight. Stay tuned for our next Tuesday talks, where we will be talking to you about 3 defensive stocks in your portfolio. Also use the hashtag AskExpert at GEPL Capital on Twitter and get all your questions answered on the stock market. Thank you.